Hi, everyone, and thanks for joining us. I'm Rick Buczynski, Chief Economist here at IBISWorld. As many of you may know, more than a year ago, IBISWorld launched our financial ratio service designed with our hundreds of commercial banking clients in mind. Actually, this was driven by their need to develop a benchmarking tool that's based on official data and not surveys that are by nature biased towards high-performing industries. Plus, granularity was really important to them, so IBISWorld's coverage of thousands of industries clearly fits the bill. And that's what we're here to demonstrate today. I'm delighted to be joined today by my longtime friend and colleague, Dev Strischek. Dev and I have collaborated on many projects for nearly 2 decades. Dev's now busy with his own consultancy following almost 20 years at SunTrust Bank, where he served as Senior Credit Policy Officer. I'm also joined today by my IBISWorld colleague Jim Furman, who leads our commercial banking client service department. Jim has been the driving force behind this training project, so it's best if I just hand the baton over. It's all yours, Jim.
Thanks, Rick. So, where this conversation really all started was an article that Dev had recently posted on LinkedIn that I took a liking to. It's titled Two or Better, the Rationale Behind the Current Ratio. And really what it spoke to was the importance of, one particular ratio, that being the current ratio, but also kind of bringing some light to the subcomponents that make up ratios that we look at every single day in the banking world. And what Dev highlights is how 2x has kind of become the standard, the rule of thumb for the current ratio. And he explains it as being a really great shortcut to understanding a business's health, as long as that shortcut works. Now, Dev, having been in the industry a long time, actually offers some great anecdotes about his own experience relying only on the current ratio, and I certainly recommend checking it out. But again, what he really highlights is how these components of particular ratios within the article, the current ratio, what we'll talk about today, debt to net worth, have come to light because each of these deals require a little bit more nuance, right, within the current ratio. How quickly can a business turn over cash and turn over receivables and clear inventory? Those are important things to measure. And as we speak more today about debt to net worth, Dev will be able to expand more on the importance of some of the components that make up that particular ratio. So now I will kick it over to the next slide where we look more at what IBISWorld has to offer in this capacity. So at this point, IBISWorld covers 70 different ratios, these being the most popular ratios we found across the banking industry. And we're pulling these ratios from data collected by the IRS. And included in these ratios, you'll find liquidity, coverage, leverage, and different operating ratios. Now, the debt to net worth ratio in particular, this is really simply defined as the total liabilities divided by tangible worth. And how it's summed up, how to interpret this, is the ratio really demonstrates the relationship between contributions of creditors and ownership. And the higher ratio, which is what you want to avoid, suggests longer term risks for your creditors, since there's less cushion provided by the ownership. Now, Dev is going to be speaking more about the rise of importance of debt to net worth, but for what's on the screen now, it's important to highlight where this information can be found within IBISWorld, within the key statistics chapter, on each of our 1,500 different industry reports. Also important to highlight, within each of these reports, for a better peer-to-peer analysis and for more accurate benchmarking, you can segment these ratios by business size based on their assets. So in that filterable column, you'll be able to select for the ratio set that matches up with your customer best. But at this point, I'll kick it over to Dev, and he'll be able to explain more and teach us more about the debt to worth ratio. Dev.
Thanks, Jim. And let me offer some background on ratio analysis, starting with a brief history. We really didn't have ratio analysis until we had financial statements. And financial statements began to evolve in the 1890s as companies selling bonds and stocks on Wall Street rightfully had to provide financial information. Balance sheets and income statement information gradually became more complex. The balance sheet offered assets, both current and non-current, current liabilities and non-current liabilities, and equity. With those basic subcategories, we now have the pieces of the puzzle for ratio analysis. The current ratio emerged early on, particularly after a number of mercantile bankruptcies in the early 1900s. The idea being that there ought to be enough current assets available for liquidation of the current debt. And for many companies, basically they had receivables and inventory and cash, and then amounts due the bank and due trade creditors. So out of those bankruptcy hearings, the idea of a 2-to-1 current ratio began to be accepted as a good minimum, recognizing that half of the current assets could be thrown away and you would still have enough to pay off the current debt. As the current ratio began to be used as a measure of liquidity, the debt-to-worth ratio began to be seen by both lenders and borrowers as a fair division of funding for companies. And the idea began to emerge there that a 1-to-1 ratio was very, very good. The banks didn't want to become permanent partners, and putting equal amounts at risk seemed to be the right thing to do. Out of the balance sheet information arose the static ratios like the current ratio, the quick ratio, receivables and cash to liabilities, not requiring reliance on the inventory. The other thing that began to show up are income statement numbers. And so the gross profit margin was seen as a good way of making sure that companies were charging enough to cover the cost of whatever they were selling or making. The profit number began to be compared to revenues and then to net worth and then to total assets. To net worth to give the owners some justification for their investment in the company. The the gross profit and the profit to total assets were seen by lenders as a way to make sure that we were earning our way through use of all of the assets. The industry ratio analysis had to have industries to take a look at, to compare with. And so two early contributors to that were two fellows, Alexander Wall and Raymond Dunning, who happened to be officers at Robert Morris Associates in Philadelphia. And they had compiled the very first of the RMA annual statement studies back in 1914. In 1928, they polished up their ideas and produced a book called Ratio Analysis of Financial Statements. And many of our definitions and interpretations of ratios stem back to that book. It was a companion piece, of course, to the annual statement studies. About 20 years later, Roy Folk, research vice president and analysis vice president at Dun & Bradstreet, published a book that added more ratios to the mix, relying on Dun & Bradstreet industry analysis. And the industry analysis got off to a great start with World War II's invention of the SIC, Standard Industrial Classification Code for war production. Later, that was replaced in the 90s by NAICS, but it made it possible for us to have a standardized, homogeneous way of compiling who was in an industry and how big that industry was. Common sizing was one of the first things that popped up in both Folk's and Wall and Deming's book, basically setting everything to 100%, the balance sheet at 100% of total assets, and of course the income statement at 100% based on revenues. The ratios began to fall into categories. The profitability ratios, profit after taxes compared to revenues, net worth, and total assets. The productivity ratios based on sales generated by total assets, liquidity ratios, the quick ratio, the current ratio, days receivable, days inventory, leverage in various variations on the debt to worth ratio, solvency starting first with comparison of ability to pay interest or to cover interest expense. And with the 1988 introduction of FAS 95, the cash flow statement, we began to see cash flow measures evolve. And a second companion item to RMA's industry analysis was its cash flow and probability default statistics in partnership with Moody's. Well, so we've come a long way. The industry ratios sources included trade groups. I'll make one up, the National Association of Grocers. But the trouble with some of these industry numbers was that they were often ways to hint to the membership that the gross profit margin ought to be 25% or higher. The RMA statement studies has been around for 100 years. Certainly, there are other sources, the IRS, the SBA, other governmental and non-governmental organizations. But IBISWorld has drawn on those sources and compiled its own financial industry ratios. If I were to offer a comparison between them and RMA, it's simply that the RMA numbers come from data provided by member banks on current borrowers. And so what you get with the RMA ratios is what the current ratio is for, say, electrical contractors that are banked. For the non-banked customers, you want a broader base. And I think that's where IBISWorld offers an alternative. Some companies are looking for an opportunity to extend credit to these non-bank companies, and I think the IBISWorld numbers give you that ability to do so. So with that, let me pass the baton back to Rick, and thank you very much.
Thanks, Dev, and thank you all for joining us today. If you need further information, please contact your IBISWorld representative or email us at commercial-banking@ibisworld.com. And also feel free to reach out directly to Dev via his email. Thanks again. Take care.